So picture this. You're in the highest tax bracket, right? And your wife is in a lower one. Maybe she's taking a break from working right now. You've got this great investment flat pulling in solid rental income. It's natural to think, hey, I'll just gift the flat to her. She gets the rent, pays zero tax, and we keep way more money in the family. Seems like an absolute no-brainer wealth building strategy, right? Well, actually, scratch that. It's a trap. You tie a nice little bow on that gift deed, hand it over, and bam, it comes flying right back at you like a boomerang. Next thing you know, you're staring at a massive tax notice. You tried to do a little family tax optimization, but instead you just stepped directly into a legislative landmine. And that landmine has a very specific name: Section 64 clubbing. Here is the 10-second breakdown. If you gift an income-generating asset to your spouse, the tax man literally does not care. That rental or interest income, it gets clubbed right back into your tax bracket. The asset moved, sure, but your tax liability, it didn't budge an inch. Now you might be wondering, okay, so what does this all mean for my wallet? Well, get ready, because this is where it gets scary. The crucial number here is 248%. If you don't declare that clubbed income on your tax return, you aren't just politely asked to pay the missing tax. No way. Under Section 270A of the Income Tax Act, misreporting your income can trigger a penalty of up to 200% of the tax owed. And it gets worse. Add in the mandatory interest of 1% per month under Section 234. If the tax department audits you, say, 4 years down the line, which is 48 months, that's 48% in interest alone. Combine that with the 200% penalty, and you are staring down a catastrophic 248% cumulative exposure on that hidden tax bill. It is an absolute wealth-destroying mistake. And if you're thinking, I'll just slip under the radar, you really need to hear this 2026 scrutiny update. Thanks to AI cross-referencing family PAN cards in real time, your detection risk is now higher than ever. To break that down a bit, let's look at the new 2026 tracking thresholds. Under the updated SFT rules, registrars are automatically reporting property gifts over 45 lakhs. And banks, they're reporting cash deposits over 10 lakhs. It's totally automated. So if the system sees your spouse earning rent or interest, but doesn't see it clubbed on your return, boom, it's an automatic red flag and an instant notice. So let's pivot to some solutions. 4 legal alternatives: how to properly optimize your family tax bill. Don't panic. There are absolutely legal pathways here. Let's do a rapid-fire rundown of 4 bulletproof strategies. 1. Independent income purchase. Your spouse uses their own earned money to buy assets. Easy. 2. Tax-free instruments. Gift the money, but invest it in tax-free bonds or a PPF, so the clubbed income is essentially zero. 3. The income-on-income rule. And 4. Prescribed rate loans. Let's actually unpack those last 2, because they're real game changers. The difference between a flawed method and a totally solid strategy is actually super simple. Look, if you just directly gift the money, Section 64 hits you hard. But if you execute a formal loan agreement with your spouse, complete with a market-linked interest rate and a proper repayment schedule, you bypass the clubbing entirely. Yes, you pay tax on the interest you charge them, but all that future compounding wealth, that is taxed exclusively in your spouse's lower bracket. You've officially and legally shifted the wealth growth. Okay, now for strategy number 3, the income-on-income rule. Honestly, this is probably the greatest wealth-building loophole hiding right in plain sight. Indian tax law is incredibly specific here. Only the first-level income from a gifted asset is clubbed. Reinvested income is not. So think of it like this. Let's say you gift your wife 10 lakh rupees, and she puts it in a fixed deposit earning, say, 70,000 rupees in interest. That 70K is your first-level income. That gets clubbed back to you. But, and here's the magic, if she takes that 70,000 rupees and reinvests it into a new fixed deposit, the 4,900 rupees of interest generated on that specific amount belongs entirely to her. It is assessed strictly in her tax bracket. Fast forward 10 or 20 years, and this secondary income compounds into a massive, completely independent, unclubbed financial corpus. It's absolutely brilliant. So what's the bottom line here? Family tax planning is absolutely essential, for sure. But doing it informally with casual gifts, that is just a ticking time bomb, especially with those 2026 AI tracking updates we just talked about. You've really got to use formal loans, track independent income, and leverage those income-on-income accretion rules to stay safe and optimize your wealth. I want you to take a really hard look at your family's asset transfers today. Are you inadvertently exposed to a 248% boomerang tax notice? Honestly, do not wait for the tax portal to send you a surprise intimation. DM me the word clubbing right now, and let's do a completely free Section 64 exposure check on your accounts. Be proactive, structure it legally, and let's keep your hard-earned money exactly where it belongs.